also like to thank everyone who is attending today, and hope that I'm able to impart some knowledge that will help you in achieving your financial goals. So this was initially meant to be a talk purely for students, but I understand the scope of the audience has expanded. So just to get a sense of my audience here, I would like to know two things about you. One, are you a student, homemaker, or employed in any capacity? It could be permanent or contractor. And two, do you currently own RRSPs, TFSAs, or both, or none, whatever, right? So I'll give you a few seconds for you to type into the chat, and then we can go ahead with the presentation. Okay, I see. TFSA, none. Okay, so I think getting a good understanding. Um, all right, so moving on to the next slide. You have three numbers on the screen. This is part of a formula that many investing webinars talk about. Can you guess what that formula is? You can type your guesses into the chat. Okay. Now let me give you a clue, right? So it's like $1,000 invested 38 times with 20% return on each trade, right? It gets you what? So if you notice the events poster, the answer is there. It's yes, $1 million. So if you take $1,000 and the first trade you get 20%, you take that amount, put it in your next trade, get another 20%, and then put that whole amount, and you do this 38 times, you will get $1 million. So this is what the math says, right? So now that I have your attention, let's go to what my journey so far has been and what I have learned from it and what you could possibly learn from it. So I'm not a financial advisor, right? Like, so I guess I don't need to give the standard spiel about investing, advice, risk, etc. But I would say that we're dealing with money here. So please be responsible with it, and all the laws of nature about risk and reward continue to apply. So I started investing in the true sense of word way back in 2009. I had got a job in a bank, and I was a permanent employee. And as part of the HR process, they gave us a lot of bank-related freebies. So you had like a free checking account, free brokerage account, employee stock loan, and of course, like the standard good life membership, gym membership. So it was an interesting time to be an investor. The whole financial world was melting down, and everything was going down, right? Like while the trigger was in banks, the liquidity crisis it created affected regular brick and mortar companies as well. So the whole stock market was in a sell-off, and a lot of the so-called blue chip companies, like the stocks of them, like they were in a free fall. But people still didn't get in because they did not know what the floor was. So you get in today, and suddenly the stock could again go down. So everyone was hesitant to get in. So my first stock that I invested in was my bank's own stock. Right, it was like a word of appreciation for hiring me, but more importantly, they had this policy of like an employee stock loan that you could use, and but you can buy only the bank stock, right? So that was the only reason I got in into that stock, and it was already at like one third of its previous high, and it was one of the few banks that didn't was not affected by the whole liquidity crisis. So they were one of the few banks that didn't have to be bailed out, and they did well, right? Like, so it was a relatively safe stock. Now, pretty soon, Once the bailout was passed in the US Congress, the situation solidified and the confidence returned to the markets, and all the stocks started going up. There were so many cheap stocks back then, and it was a shame to see so many opportunities going away. But I was new and I was very skeptical, and I didn't want to touch anything with a bargeboard. Even though my investment had almost doubled now, thanks to the bailout, I wasn't sure if the market will come crashing down again, right? So you're not doing anything new. And then the other thing was like, there was no capital for me to invest, in these blue chip stocks that was so cheap back then. So Apple was so cheap, it was on the upswing. At that time, they had just introduced the iPhone, and their whole growth trajectory was just starting. So, taking all the stock splits that have happened in that stock, from that time, like at that point, if you had invested $10,000 in Apple, it would be close to $1 million now, right? But Mafi Fulus, no money, so you just live with it. So moving on. So a few months into my investing experience, I was introduced to this thing called day trading. So nowadays it's the other way, right? People get into stock markets because of day traders and headlines that talk about overnight millionaires, like GME and whatnot, right? And you'll hear terms like YOLO, FOMO, right? You only live once, fear of
Yeah.
missing out, and you get caught up in the rush.
Wow.
Well, I did too, right? So at that time, a lot of banks were going up, going belly up, right? So their stocks were cheap because of the liquidity crisis. Nobody knew how many banks were exposed. So every bank stock went down, right? And then the process was like, the stock used to go up was if they got bailed out by the government, the price goes up, it shoots up. So sometimes it's like $1 becomes like $20 the next day, right? But on the flip side, if they get nationalized or they go bankrupt, then everything becomes worthless. So there was this bank, AIB, Allied Irish Bank, can never forget that, which I was tracking. And I got in cheap, and the bank got a bailout, and the stock shot up like 3 to 4 times, right? And then in a few days, the bank had so much exposure. So once you do a bailout, the government adds more, audit requirements and whatnot, right? Like so, there's a microscope on the books, and obviously it exposed that it had a lot more exposure to the liquidity crisis. And then they got nationalized, right? So the bank got nationalized. So that's it. So my portfolio, which was so good looking, green and happy, when AIB got a bailout, became like this. So that's it. Like my investing journey came to an end there. So this is way back in 2010, 2011. So after that, whenever your colleagues or friends, you know, come and talk about like the happy stock market stories, I used to just nod or get away from it, right? It's like love stories. Your friend sounds always rosy. It's like DDLJ, all good endings and not, but your story is completely not like that. So moving on. So after that, a few years later, I happened to buy a Tesla car. So, for those people who know me, I love the vehicle and I can't stop talking about why others should buy it as well. So, for those who you don't know, like Tesla is an electric vehicle manufacturer. And if you don't own one, you should. That's my standard spiel. So, there's an interesting incident that happened to me, which made me go back to the investing world, and it's related to Tesla. So, I had a colleague of mine, my coffee buddy, and in between a conversation, he came to know about my Tesla, and he was asking about the range, company, service, etc. So as usual, I went on this long rant about the superlatives of the car, the company, and the strategy, the genius of Elon Musk, and at the end of it, I thought I'd convinced him to buy a Tesla, and I gave him my referral code, so that I get some goodies, right? So a few weeks later, I asked him, if he had booked the car or he was planning to buy the car. And his answer really surprised me. So, do you know what he did? So, he did not buy the car, right? So what he did was he invested in the Tesla stock and he made a lot of money. So I think he's a professional trader. So he played around with options. So he made, I think, close to 20-25 grand. With just with an exposure of like maybe a week or two in the market to that stock. So his rationale was that if what I say is true about the car, about the company, then the stock was very valuable. So he basically used my research and made money in the stock market, right? And here I was still thinking about the AIB fiasco. Didn't want to get in. I didn't. It was a bad experience. So you don't want to get in. So, but then you have this example where somebody used my research and made money, right? So that's when it hit me that the stock market is a reflection of the real world, right? I know some might argue, the current stock market doesn't reflect it, but a large percentage of the stock market participants invest based on the real world. And for all you know, your participation in those innumerous flame wars, right? Like Apple Android wars, electric cars, gas cars debate, they might actually make you money. I mean, like when we have those debates, we are basically reading upon these tons of articles, trying to figure out which is better, why is it better, all of these things that we do. I'm sure many of us have done that, right? Like I participated, I know some of the participants here have participated there, but basically that is research. At the end of the day, that is research, and if you apply that in the stock market, you could actually make some money, right? Like so you just need to apply it in the right space. It shouldn't be on WhatsApp, just do it in the stock market. So with this incident, it really struck me. Like here I was trying to sell a car, and he gave me knowledge about, like, how you invest in stock markets and how you do it. Right? It's not about day trading. It's not about fear of missing out. It's about proper research and how you get into certain companies based on that. Right? So with this incident, I got back into um, the stock market, and with that, I want to come to, like, the third part of my presentation. So when worlds collide, right? So here are some infographics from a recent Bloomberg article about some ordinary folks who invested, like, say, in Tesla. Right? Like, so on the left, you have somebody who invested around $6,000 way back in 2010 when the company came out, and he stuck with the company, and then the timeline is there. There's a lot of ups and downs, but then last year it really made a big difference, and he was able to make $1 million. But he basically stuck with the company irrespective of what happened. And on the right, you have an infographic where over the different period of time, the amount of money that you put in a company like Tesla, you would have made like $1 million, right? Like, so the reason I'm putting these infographics is because I want people to understand, like, the power of stock markets, right? Like, yes, I had a bad experience with the AIB thing, but there is also, like, examples like Tesla where, if you do your due diligence, you can actually make money. So with my newfound enthusiasm, right, and my experience from my old sob story, I started investing more diligently this time. So I did research and figured out, like, what are the high growth companies, and started investing in them. So that is very important, because you are putting your money in. You need to know why you're putting it in. You need to know why it is going to grow. So you do that research, and you'll be more confident, right? Like, it's like any asset class, right? Like, you invest in gold because it is, there is a certain value to it. You invest in real estate because there is certain growth trajectory to it. You don't, even at the same time, you don't go and invest in a home which is in a bad neighborhood, or which is never going to go up, right? Like, so something similar, right? Like, so stocks are like that. You just need to do um, your research on that. Then diversify, the second part. So you probably have already heard of this, right? Like, don't put all your eggs in a single basket. Likewise, you do not put all your money in one stock. Diversify. Invest some in high growth stocks so that you get some good returns. Invest some in dividend stocks, which are like more stable. You get some money, like not much, but it's some. The prices are stable. Invest some in metals, cryptocurrency, or other assets. So diversification is very crucial. And the next thing is start small and add more on dips. So say if you have $10,000, don't go and invest the whole amount in one stock or fully, right? Keep aside some money. So the stock market is like that annoying game, Flappy Bird, right? Like, you have this bird that goes between obstacles, like, but goes up and down. Stock market is like that, right? Like, so irrespective of which stage of the game you are in, the bird is continuing to going up and down, right? Like, so the stock market is also cyclical. It will go up, it will go down, it has its cycles. So you need to understand that, right? Like, so the reason that you need to have some extra money in hand is like when it dips, you get into the market. Like, if there are some stocks that you like, there are some stocks that you've done your research, you already invested in it. Sometimes it's going to go down, right? Like, but our first in like our first reaction at that time would be to sell the stock, right? And because it's going down, right? Suddenly you're seeing reds. But in a stock market, if you've done your research properly, like stock markets, that's expected, right? Like there will be dips, there will be ups as well, right? Like, so you buy when it goes down. Those are buying opportunities, so you should treat them as such, right? So, and people always talk about a stock market crash. I guess you have it every often. They always talk about, oh, it's going to crash soon because it's the current stock market, right? So you have to expect that even when you are in the market, you can't time it, right? So let's be clear on that. But you should have that expectation, and the way you do it is like you have some money extra, so that when it dips, you buy more, and then your average price of your stock suddenly goes down, right? So that is how you, now when it goes back to where you were, you've already made some money out of whatever you had before. So these are another way to do it. Then the fourth part, right? Like this was an like affiliated stocks. So this was an interesting development for me. So it's quite obvious if you're in the stock market, but for newbies, this doesn't quite appear so obvious. So if a stock like Tesla is doing well, right? There will be affiliated stocks that will be going up as well, right? Like, so Tesla is a car, right? But it needs to have components from other companies. So if you have done your research in one stock, right, and then you understand, okay, this sector is going to boom up, expand your research to see what other stocks are there that are part of that growth story, right? So in this case, during the early years, NVIDIA was the chip that was used for autonomous driving. So whenever Tesla was doing well, NVIDIA was doing well too, right? So as part of my diversification principle, I invested in NVIDIA. So it's a different sector, right? But it's in a way related. And the growth or fall is part of the overall, uh, the same overall story, even if it is different sectors. So one research, two stocks, you can ride the momentum on two stocks. And even if the automobile sector goes down, at least the chip sector is still doing well, so you still have some gains there, right? Like, so you kind of evens out, or you still are better, you're still better ahead in the game. And finally, the most important piece, taxes, right? So this is where some of what Tinsy mentioned earlier really comes into play, right? Like, so let's say if your story is like DDLJ, right? Like, you had a very good story, you had a very good ending, you made some money, but don't think you're off the hook so easily, right? The government needs some too, right? Like, so in Canada, we have to pay taxes on 50% of your capital gains. So if you invested $100, um, and you got, like, say $110, right? Like, so $10 is your capital gain, and you have to pay taxes on 50% of that, which is like $5. So make plans to keep that aside. Or if your growth was in the TFSAs, you don't have to pay these taxes on those capital gains. So just at a very high level, that's my investing story, and that's happened so far, and I hope to be part of this investing, for some more time. So I want to go to the next part, right? Like, so the final segment, I want to give some tips and tricks that I think might be useful for people who are new to investing, or who have already, I see some people have already have TFSAs and RRSPs. I don't know what kind of TFSAs and RRSPs are there, right? Like, so I just want to talk about that, for a few. I think I still have some time, so I'll just get to that quickly. Okay, so first thing that you need is a, brokerage account. So that is like the mandatory thing, because you need that to buy or sell stocks yourself. Then you do have other options like a mutual fund, which I still think you need to have, like a brokerage. Like, you can invest in a mutual fund directly, or there are people out there like financial products that you can go and buy directly. But in this case, so there are many different types of brokerage accounts. So you have, the no fee one. So basically, you just pay for the price of the stock. So you have Wealth Simple, Robinhood, as some of the examples of that. Wealth Simple in Canada, Robinhood in the US. Then you have the fees, the brokerages that charge fees, like Questrade, Interactive Brokers, and most of the major banks in Canada, like TD, CIBC, RBC, BMO. All of these folks have a brokerage product. And then you have Wealth Simple again, which is like a robo advisor, like an auto invest. So if you are not too keen on investing, but you just want to be part of the stock market, you could use something like this. They use AI and machine learning, to intelligently invest, right? So an ideal brokerage account, right? My advice is, it's best to have everything in one place. So it should be like so wherever you have your checking and savings, wherever you have your checking and savings account, just open your brokerage accounts there, and don't go with a no fee account. That is very important, because most of the time, so if if anything is free, then that means you're the product, right? It's actually proved in the case of, like, say, Robinhood, and I'm not sure about Wealth Simple, but anytime there's no fee, then you are the product, your trades are the product. So that data is very crucial for them. They can front load your trades. Say if you're buying a trade, through Robinhood or Wealth Simple, the people on the other side already know what your trade is, right? Like, so that's the data that they sell. So it's good to not have that no fee account. So always go with one, even if it is, if you have to pay a fee, it's still worth it. And more importantly, these, like Wealth Simple or Robinhood, they are separate, like companies, right? Like, so they don't have your checking or savings account, so you still have to do some transfers. So if you are transferring money, it takes, I think, 2 days or something like that, a best case scenario. And by the time the stock market would have moved, right? Like, so you're looking at the stock and you're like, oh, you know what, I want to buy it. And you have to go to your bank, make the transfer to Wealth Simple, and by the time the stock's either gone up, and you've already missed your opportunity. So that's why it is important to have everything in one place. And the last thing is, very crucially, have multi-currency accounts. So by that I mean, have a USD denominated account, and have a Canadian dollar denominated account, right? And the reason for that is, we can trade both in US and Canada. So if you have a US dollar account, and you buy and sell stocks in the US stocks, and if you have a US dollar account, you save on the foreign exchange fees versus I don't know if I think it's Qstrade. I don't know if they have a US dollar account, and there are some brokerages that don't have a US dollar account. So you actually lose both on buying and selling FX fees, right? And so that's why it's very important, if you're serious about investing and trading in stocks, have multi-currency accounts. The other thing about multi-currency accounts, right? Like, so you have this forex trading, right? So people actually make money out of forex trading, right? So if you have these two accounts, just by you following the Bank of Canada announcements and the US Fed announcements, the US and CAD, it always fluctuates, right? Like sometimes it is the CAD is higher, and sometimes it is lower. So you can actually just keep trading money, have $1,000, just keep trading money between the US and CAD, and you can actually make money if you if you follow those news properly. And again, it is cyclical, right? Like it is there is a certain time where it goes up, where it goes down. So if you know that, you just by the act of transferring from your US dollar brokerage account to the Canadian dollar brokerage account, you make money, right? Again, I'm just saying this just as a tip, right? And in my experience, I use TD, and I'm very happy with that. They have whatever is mentioned here. So something that you guys could look at. So the next one. All right. So picking stocks, right? So this is one of the questions that I received. Which stock should we invest in and whatnot, right? Like, so it. I'm not going to give any individual stock because I believe that it is very important. If you're investing, you have to do your research and do your due diligence, right? So sometimes, so even if I give a stock, sorry, even if I give a stock name, right? Like, so you have to stay with it, right? You have to follow it, you have to understand what it is, and you have to make your movements across based on that, right? Like, so I might say a stock A, and then 3 or 4 weeks down the line, I feel that it is peaked, I need to get out, right? Like, but you're probably still thinking, okay, as Salim mentioned this, and I'm going to be putting there, and then it can go down, right? Like I mentioned, like the cyclical part. So never go by suggestions. Always good to do your research and your due diligence. And not everyone has the time to do that, right? Like, so the next best option is to do ETFs. So ETFs is basically exchange traded funds, so it's not just one stock, so it's a basket of stocks. So some of the examples are like all the stocks traded in the TSX, right? Like, so if Canada does well, the TSX does well, the TSX ETF goes up. Then you have the SPY, which is like the S&P 500, which is the top 500 companies in US. If they do well, the ETF corresponds to their performance. And then this is something I would suggest. There's this company called ARK Invest. I'm a big fan of Kathy Wood, who's the CEO of ARK. So they have actively managed the ETFs. So some people think that Tesla's too high. They don't want they can't get in now. ARK is the best bet, right? Like they have some ETFs that are like full of like the majority or a huge portion of their investment is Tesla, and their ETFs do really well, right? Like, so even if you have some money there in your RRSPs or TFSAs, you just put them into ARK ETFs, and there's a decent return that you get from those ETFs. So you're not actively trading, but you're still part of the stock market, and it is one of the, I think, if you look at different asset classes, the chances of getting higher returns are, in the stock market, right? Unless you're in the Toronto housing market, that's a different thing altogether. And then you have the robo advisor, which is basically like Wealth Simple, where you just say that what your preference is, like whether you want a risky, which is high growth, or you just want low growth, stable, you don't want to lose your capital kind of thing. So you can use one of those. So Wealth Simple is great. I use that for my RESPs. And it's also good, if people who are into halal investing and whatnot, they have a halal portfolio as well. So you could use that. And then last one I want to focus on, right? Employer stock contributions. That's something that a lot of people don't use. If you're using, that's great. So for those who don't know, right, so different companies have different plans, right, but generally, at a high level, what it means is, you can buy your employer's stock at a discount, or they will do a contribution. There are different policies, right? Like, so each company would be different. Most of us work in these big companies or banks, TD, CIBC, BMO, right, or Loblaws. There's so many big companies that are publicly traded in Canada. So see if they have a employee stock option plan, like employer contributor plan or something, right? Just go and take that. And the best part, so for example, in TD, when I was there, they used to have this discounted stock option. So you can buy TD stock at a discount. So if the market is selling TD stock at $100, I can buy it for $80, right? Like, so as soon as it's in my account, I already immediately gain $20. Like, just that, right? Don't do anything else. If your employer has a employer stock contribution plan, just go do that, right? Don't think, oh no, it's a crappy stock. You might know, what is a crappy company, whatever, but you immediately get benefit out of that, right? Like, some people need to wait like months to get that $20 or $30, but you immediately get that. So use that. That's a great option to immediately benefit from the stock market. Yeah. So my final thing, right? I want to talk about saving taxes. So first, make sure that you have like a registered trading account and a TFSA trading account. So RRSPs and TFSAs, it can be many things, right? Like, it could be just there are some products that's just called RRSPs. RRSPs. So you put money there, it's just a cash account, right? Like, so it's an RRSP, a contributor, you're keeping it away. Then there are some, where some of the financial products out there where they do investing on your behalf, right? Like mostly mutual funds or whatever. Again, it's an RRSP, but they take care of what you're trading and whatnot, right? Like, so that is another thing. So there is this other type of RRSP. It's like a trading RRSP, and most of the banks would have that. So in that, it's pretty interesting because you can actually hold cash and your stocks in it, right? So for example, so you transfer 10,000 in your RRSP, you convert it into your trading RRSP. Now that cash is in the RRSP, right? And then you like a stock, you want to buy a stock, you can actually do that, right? Like, you can invest in the stock, and if the stock goes up, you can sell it. That money is sheltered in your RRSP now, right? Like, so you are more in control of your RRSP, of your how you use it, right? Like, so most of the time, mutual funds, I mean, no fault of theirs, right? Like, so we give them, we are not going to be happy if the money goes down, right? But we have some leverage. So some money that you think you want to play around with, have an RRSP for trading, right? And likewise, an RRSP, a trading TFSA, right? So this way, you can actually invest in the stock market using the RRSPs and TFSAs, and shelter your tax gains, right? So the second part is maximize the RRSPs. This is very, very important. If you don't have an RRSP, go get one, right? Like, so Canada is a high tax country. Utilizing the RRSPs is very important. Most of us are, I mean, we might not be millionaires, but we earn a decent amount of money, and we're probably, in the second or third, highest tax bracket. So it's very important. If you don't have an RSP, utilize that. That is very, very important. Only because once you maximize your RSP, right? Like, so you actually, based on the tax that you're paying, you probably might get a refund, and you can take that refund and put it into a TFSA, cash or trading one, right? Like, so you put that. So it's basically, you shelter any money that you get from your refund, you shelter it in the TFSA. And if you grow it, good. The government is fine with whatever capital gains you make there. And you say if you invest in a stock, it goes up high, doubles or whatever, you can get that money out, right? Like, so that is the power of RRSPs. And then the last part I want to talk about is utilizing kind contributions. So I want to give an example for that, and after that we can go. Oops, I don't know where that came from. Um, so let's say you have a trading account, right? Like, so let's take a hypothetical scenario. After this webinar, you got so excited, went to TV, opened your trading RRSP. You have your the trading TFSA and a regular trading account. You did some research. You like, the ARK Invest Innovation ETF, ARK, okay, and you went and bought some 100 stocks of ARK at, like, say, $150. At the end of the year, the stock has gone up to $180 now, and you want to sell it because you want to pocket the gains, right? So if you do it in your regular trading account, then you're liable to pay taxes on the capital gains, right? So in this case, it's like 50% of $3,000, which is like $1,500. So if you're in a high bracket, then that's like $750 gone. So how do you save taxes? So this is how, right? Like, so you do an in-kind contribution. So what that means is you have 100 stocks of ARK. So you basically say, I want to contribute 15,000 worth of stock into my RRSP, right? So they do the math. You can't do fractions, so they round it to the nearest whole number, and they move that number of shares into your RRSP trading account now. So it's still shares, it's still, you're still owning ARK, whatever number of stocks that is, but it is in your RRSP trading account now. So if you sell in the RRSP, you don't need to pay tax on that capital gains, right? Like, so you've saved whatever, portion of that 15,000 RRSP. So now typically you get a refund, right? Or, even if you don't have a refund, you have around 5,000 per year. Tinsy mentioned that number, but every year there is a certain number. You can use that remaining stocks. You put that into the 3,000 into your TFSA, right? So now, sum total, you pay zero taxes. So that's how you save taxes, using a trading account, RRSP trading account, and a TFSA trading account. So if you're serious about investing, if you think that you want to get into tax, if you're already doing this, but you don't have the RRSP or the TFSA part of the equation, I strongly advise that you do that, because you can save a lot on taxes, especially with TFSAs. If you've never been in it, or RRSPs, if you've never been in it, if you go to your MyCRA account, you probably will see that you have a huge contribution room, out there, right? So I mean, probably we don't have that much money that they say that it is there, but it is there. So if you invest in a stock, it goes up. Now you can move that money as an RRSP into your RRSP, like as a contribution, and that will reduce your taxes, right? And if you get a refund, put that into your TFSA, so you kind of save taxes that way. So that's one thing that has worked, and I would strongly advise you do that. So that we come to the end of the presentation. Thanks everyone for watching. If you have any questions, I can address it during the Q&A session. I'm also available offline in case you want more information. Feel free to reach out to me.